Welcome to lecture 27 of financial management, and this lecture is regarding cost of capital. So let's move towards the contents. We are going to discuss the examples of cost of debt, examples regarding cost of equity, and then we are going to see examples regarding cost of preferred stock and the WACC or cost of capital. Okay, so starting with the first example, the Down and Out Corporation just issued a dividend of $2.4 per share on its common stock. The company is expected to maintain a constant 5% growth rate in its dividend indefinitely. If the stock sells for 52 per share, what is the company's cost of equity? Now, first thing, if you remember cost of equity, we discussed two methods, two models. One was dividend discount model that we can use to find or calculate the cost of equity. The second model was the CAPM model. So which one would we use in this case? Because we have the data regarding dividend, so we are going to use the dividend discount model as opposed to capital asset pricing model. If we had the data regarding capital asset pricing model, then we would have used. But in real life, obviously the CAPM model is more superior to dividend discount model. So in real life, we might prefer using CAPM model. Okay, so we are going to use dividend discount model. If we had both the data for CAPM and dividend discount model, we could have used both, and we could have used the average of both the models to further use that cost of equity in the WACC formula. This is what we can do. Okay, so in this case, it is saying that so one thing we know that we are going to use the dividend discount model, and the formula for dividend discount model is RE is equal to D1 divided by P naught plus G. Now, if you remember, we have converted the dividend discount model formula to find the cost of equity. So we need a D1, but in this case we are given the value of D naught. How do we know it is D naught? The company just issued a dividend. So when it says just issued a dividend, so it is D naught, previous or today's dividend, right? And D1 means the dividend at time period 1, the next dividend, and dividend 2 means the dividend at time period 2. So in this formula, we need dividend 1, but the value that we had been given is dividend 0, D naught. So first thing, we are going to convert this D naught into D1, and how do we do it? Is D naught into 1 plus G raised to power 1. This would be equal to D1. If we wanted to find D2, then it would have been D naught into 1 plus G raised to power 2. Okay, second is we are going to input that value into this formula, and the rest we are going to use in this slide. Okay, so we just discussed that our formula is RE is equal to D1 divided by P naught plus G, and we need to find a D1 because the value that we had been given is D naught. So the formula to find D1 would be D1 is equal to D naught into 1 plus G, and the value of D naught is 2.4, G is 5.5%. so if we divide this by 100, we get 0.055 plus 1.055. D1 is 2.53. So what do we mean by this D1? How do we interpret it? This is the dividend that we expect. If the growth rate is constant at 5.5, then the next year dividend would be 2.53. So now we need to find the cost of equity. We need to input the D1 into the formula, which is 2.532. divided by P naught, which was 52, plus the growth rate, and the cost of capital turns out to be 10.36. Cost of equity turns out to be 10.36%. This means that based on this data, this company's cost of equity would be 10.36%. Okay, next example. The up-and-coming corporation common stock has a beta of 1.05 if the risk-free rate is 5.3% and the expected return on the market is 12%. What is company's cost of equity? Now again we need to find cost of equity, but in this case we had been given the data for CAPM model, so we are going to apply the CAPM model. We have the beta and we have the market return and we have risk-free rate, so we can apply the CAPM formula. So the CAPM model is cost of equity is equal to risk-free rate plus the beta, which stands for systematic risk, the risk inherent in the whole system, the whole market, into market return minus risk-free rate. So if we input the values, the risk-free rate is 5.3% divided by 100, so it would give us 0.053 plus the beta into 12% minus the risk-free rate. We get the cost of equity of 6.1%. So based on this data, this company's investor would expect the required rate of investor would be 6.1%. And this is based on the risk. Remember, in CAPM model, we take into account the risk element, but in case of the dividend discount model, the risk element is ignored. So the required rate of return of the investor is 6.1%. Obviously, the required rate of return of the investor becomes the cost of equity for the company. So this would be the cost of equity. If the firm is going to issue common stocks, then their cost of equity would be 6.1%. Moving to next example, and this example is related to finding the growth rate. If in case the growth rate is not given in the question, how do you find the growth rate? So suppose this ABC Corporation just issued a dividend of $1.43 per share on its common stock. The company paid a dividend of 1.05, 1.12, 19, 30 per share in the last 4 years. So these are previous dividends. If the stock currently sells for 45, what is your best estimates of company's cost of equity capital using arithmetic average growth rate? So what this is telling us is that we need to find RE, which is cost of equity, but to find cost of equity we need growth rate. So all the other elements had been given. The dividend is there, the P naught is there, but G is missing. So we need to first find the G. So how do we find G? If you remember from our dividend discount model chapter, we discussed that one of the ways to use to calculate the historical growth rate. So how do we calculate historical growth rate is what is the growth in dividend from previous year's dividend to this year dividends, and so on and so forth. So I have used this table to explain this concept. So today's dividend is 1.43, previous year is 1.05, and so on and so forth. So how do we find the growth rate in this dividend? So to find the change in percentage, what do we do is current price minus previous price divided by the previous value. So whether we are finding the return in stock prices or return in any asset, or we are finding the growth rate, the formula is current value minus previous value divided by previous value. So current value is 1.43, previous value is 1.05. So current minus previous divided by, this is 1.05 divided by previous value. So it would give us 36.19%. So these are in percentages. What this means is that the percentage increase in dividend as compared to previous year. So previous year's dividend was 1.05. This year's dividend is 1.43. So what is the growth rate between this dividend? The growth rate is 36%. So next we need to find the growth rate at this point. Current dividend is 1.05, previous is 1.12 divided by 1.2. So the growth in the dividend is minus 6.23. So this at time 2 the dividend was 1.12, at time 1 the dividend is 1.05. So dividend has essentially decreased. So by how much percentage did it decreased? It is 6.2%. So we find all the percentages and then we take the average. How do we take average? We add them up and divide by 4. So this would give us an average growth rate which is 3.9%. Once we have the growth rate, the rest is history. So we find the cost of equity by the same formula, D1 divided by P naught plus G. D1 is D naught into 1 plus G. D1 is 1.43 into 1.039. This is the growth rate that we just found, 1 plus G and 1 plus 0.039. So this is the growth rate that we just calculated in previous slide. This would give us D1 of 1.48 and we are going to use this D1 into our formula. So it would be 1.48 divided by 45, which is the P naught price plus the growth rate, and the cost of equity turns out to be 7.18. Okay, so moving on, cost of preferred stock, the second component that we are going to understand. Hold Up Bank has an issue of preferred stock with a 6 stated dividend that just sold at 96 per share. What is bank's cost of preferred stock? So we need to find cost of preferred stock and the formula is dividend divided by P naught. So why do we not write D1, D2, D3 or D naught, etc.? Why just D? The reason is that in case of preferred stock, the dividend is fixed, the amount is fixed, so it would be $6 each year. So the dividend would always, whether it is D1 or D2 or D3, they all would be similar. So we do not need to write D1, D2 or D3, simply D would suffice, and P naught would be the current price. So this is the similar to the concept of perpetuity. We find the present value of perpetuity, it was C by R. Okay, so the formula is 6 by 96, it gives us the value of 6.25. So this means that the cost of preferred stock, so if this firm issues a preferred stock, its cost would be 6.25. So we move towards the WACC. How do we find WACC? So let's take this example. This ABC Corporation has a target capital structure of 60% common stock, 5% preferred stock and 35% debt. Its cost of equity is 14%, cost of preferred stock is 6% and cost of debt is 8%. The relevant tax rate is 35%. So now you would see that in WACC formula we need two elements. One is the weight and the second is the cost. So weight of the equity, the cost of the equity, weight of the preferred stock, cost of the preferred stock, and weight of the debt into cost of the debt. So we had been given the weights 60%, 5% and 35%. These are the weights, and we also have the cost. So we do not need to calculate the cost of equity or cost of preferred stock or cost of debt. We essentially had already been given these elements. We just have to put them in the WACC formula. So first part is we need to find the WACC, and then we would come back to the second part later on. So cost of equity is 14%, cost of debt, here they have given us 8%, but this is not adjusted with taxes, so we need to adjust it for taxes. This is the nominal interest rate. Cost of preferred stock is 6%, and so cost of debt is the interest rate into 1 minus the tax rate, which turn out to be 5.2%. It would always be lesser than the nominal interest rate. Why? Is because of the tax shield, we would save some amount due to the taxes that we would pay, the lesser amount of taxes that we would pay because of the tax saving due to interest cost. So then we turn towards the WACC formula, and the WACC formula is weight of equity into cost of equity plus weight of debt into cost of debt plus the weight of preferred stock into cost of preferred stock. So we have already have all the elements. Weight of equity was 65%, 0.65. Cost was given 14%. Weight of debt was also given 35%. We just calculated this cost of debt, which was 5.2%. Weight of preferred stock was 5%. So if we have 1 lakh rupees, so out of this 65,000 would come from equity, 35,000 would come from preferred stock, and 5,000 would come from preferred stock. 35,000 would come from debt. So we have already calculated this part, so it would just be the RD, right? So the WACC turns out to be 11.2%. The total cost of this firm is the cost of capital for this firm is 11.2%, and this is what the firm is going to use this as an R in the formulas that it use to find the NPV or IRR. It is going to use this, to find NPV, it is going to use this as an IRR, because this is the cost of capital for the firm or the required rate of return, and we use cost of capital or the required rate of return as a discount rate in NPV, in finding the NPV of the projects. So essentially the firm is going to raise some capital, and to raise that capital they are going to pay dividends, etc., and for that the total cost would be 11.22%.